Welcome to the Market Update with Scott Cook. Today is Saturday, September 16th, 2023. We are going to look at what the market did last week and evaluate some important data, and then look what's coming up next week and formulate a game plan, or in other words, a market posture. It's always best to trade in the direction of the market because, you know what they say, a rising tide floats all boats. Let's start with what the Dow did last week. And you can see that last Friday, September 8th, we closed at 34,576. The Dow closed on this Friday, yesterday, at 34,618. So even though we had a huge down day on Friday, overall, we were still up slightly for the week. The NASDAQ was down slightly for the week. And finally, the big one, the one that we like to measure the entire market with, the SPX, the S&P 500. If you look at the close last Friday, it was at 44.57, and the close yesterday was 44.50, so we were down slightly. Throughout the week, we pretty much had mixed signals, but there were some pretty important drivers, some big events that made the market get kind of volatile. Monday and Tuesday, there weren't really any big events. As I go through the calendar here, you can see that for the US dollar, there was really nothing major, but everybody was holding their breath to see what Wednesday brought, because Wednesday, we were going to get the core CPI numbers. Core CPI is important because this is where consumer prices account for a majority of overall inflation. And inflation is important to currency valuation because rising prices lead the central bank to raise interest rates out of respect for their inflation containment mandate. So in other words, this is the data that the central bank is looking at to determine whether or not they're going to raise interest rates. And naturally, that's going to have a huge impact on the dollar and the stock market. So if we look at what the market actually did on Wednesday, it really didn't do a whole lot. It opened up at 44.62, the high was 44.79, the low was 44.53, so there really wasn't a lot of movement. We were expecting Wednesday to be kind of a big day in the market with the core CPI numbers being announced, yet it didn't do much. And so I think a lot of traders were expecting, hey, you know what, big news, but not a lot of movement. Let's not expect a whole lot of volatility out of the market over the next 2 days. Well, you can see that Thursday was actually a bigger day, and so was Friday. So what was it about Thursday and Friday that moved the market bigger than what we saw on Wednesday, where we might have expected a little bit more volatility on Wednesday itself? As you can see on Thursday, we had the Producer Price Index report, and that number came in higher than expected. Now, normally, that would spell trouble for the market. When the actual number is greater than the forecast, it's good for the currency, but it's a leading indicator of consumer inflation. When producers charge more for goods and services, the higher costs are usually passed on to the consumer. And you can see from this news headline right here that U.S. retail sales producer prices jumped on rising energy costs. So you'd expect that to cause some problems for the market, and we actually did see some problems in the market. We were down immediately after the report, but since all these different energy stocks were making good money, a lot of people started jumping into them, and that fueled a turnaround in the market for the day. Also, I think a lot of consumers were expecting that with the higher than expected inflation report, that means that price increases will peak soon. So after a really good day on Thursday, Friday, we gave back all our gains. Big down day. What happened on Friday? Well, the information technology sector bore the brunt of the downturn with almost a 2% decline in the S&P 500. Adobe's shares took a major hit, dropping over 4%. I was actually playing an iron condor on Adobe, and it got right down near my lower strikes, but luckily stayed just above them. Now, Adobe came out with quarterly results that surpassed expectations. But I think their future guidance wasn't as strong as the market was expecting, which is why they were down. ARM Holdings, fresh off of its successful public debut, saw its shares decline by 4.2%. The automotive sector, like General Motors and Ford, went down just a little bit, and that happened sort of in the face of thousands of United Auto Worker members initiating a strike due to unsuccessful negotiations with automakers. Also, we had the University of Michigan's consumer sentiment and inflation expectation numbers came out. And let's just focus on the inflation expectation numbers. They were actually pretty good. And if you go to their website, you can actually see the numbers here. We're going to go ahead and click on the expected changes in inflation rates. Let's look at the Excel spreadsheet. And the expectations that we came out with were 3.1 for inflation. You can see for every prior month that they've been doing this, going back a year, expectations of 3.1% really was the low. So you would expect that to be positive for the market. However, the market has had a mind of its own. It went up on some negative data on Thursday, and then it gave it all back and went down on what looked like positive data Friday. So what's going on here? Looks like a big tug-of-war happening. And on some of the days that we were expecting no volatility out of the market, we got some volatility. And on Wednesday, the day that we're expecting a lot of volatility, a lot of movement one way or another, we really got nothing. I'd like to check out this website, the AAII Investor Sentiment Survey, and it offers some insights, especially when investors, retail investors, are really strongly gravitating towards being bullish or bearish. But as you can see, that on this week, they're really pretty mixed. We're not seeing any real strong bullish or bearish sentiment, so no contrarian indicators here. So let's go ahead and take a look at the VIX and see what that's trying to tell us. Now the CBOE SPX Volatility Index, in other words the VIX, think of this as a measurement of fear and greed in the market. When levels are really high, there's a lot of fear. People are protecting their positions. They're selling call options, they're buying put options. And they're doing this because the market is going down and they have a lot of fear, they're worried, they want to protect their positions. And the market maker, they're charging more for those options. But when the VIX is really low, there's not a lot of fear. Market participants are feeling pretty confident. And when they're feeling really confident, well, that's when you want to start being cautious. This is a good contrarian indicator. And that's when you want to start protecting your positions, locking in gains, and kind of keeping an eye out for a potential market pullback. So you can see that the VIX, if we zoom in on what happened Friday, took a huge jump up. So with the big downward move that we had on Friday, a lot of people started getting really nervous. Fear creeped higher, but you can see that the VIX isn't at extreme levels. It looks like it potentially has much higher to go. And if it continues on an upward trajectory, well, what does that mean? You guessed it. The market's on its way down. The VIX generally tends to work inversely with the market. As the market drops, the VIX goes up because people are more fearful, they're buying more protection. Yet as the market's looking really strong and it's going up, the VIX goes low, and it can stay low for quite some time. But when it hits extreme levels of being low, think of it this way. It's kind of like your friend calling you up and recommending a stock to buy. But when your friend does that, usually the best trade to do is go out and do the opposite. Short that stock because your friend is feeling so confident that he's willing to call you up and tell you to buy something. Poor guy, he means well, but he's overconfident, and everybody else has probably heard about this stock by now, and they're already buying in, and there's really nothing left but profit taking, and so it's ready to drop. So the Federal Reserve's policy decision on September 20th is coming up, and Wall Street's been going through all this mixed economic data. The market's been doing some head fakes one way or another, not necessarily reacting on the data like we might expect it will. And the central bank is anticipated to maintain its current rate levels. But traders are trying to play that head game and figure out what the Fed might do and read into every little piece of data so that they can gain some insights regarding the Fed's stance on inflation. So going back to September 20th, first of all, let's look at the CME Fed Watch tool and look at what the pros, those interest rate traders, are expecting the Fed to do. So we're going to scroll down here, and you can see that they're expecting, there's about a 98% probability, based on how these things are trading, that the Fed is going to keep the rates between 525 and 550. Now, there's a very slight chance that they're going to raise rates, and you know what that might mean for the market in the short run. Probably wouldn't be super good. So let's just take a quick look at the calendar for next week and form our market posture based on the charts. Nothing really happening Monday or Tuesday, but Wednesday's the big day. This is when they come out and they have their press conference, and they're either keeping rates the same or they're raising it. Maybe they surprise us and lower rates. Highly doubt that's going to happen. Thursday, you're going to get some unemployment claims, and that might cause a little bit of turmoil in the market. And then Friday, we've got the flash manufacturing PMI. I really like this one because it's the big businesses that have all the analysts, and they got a lot of money to spend on trying to determine what the market is doing, what the economy is doing, and they're going to go ahead and react fast to those market conditions. The purchasing managers hold all the current relevant insight into a company's view of the economy, and what they're doing kind of gives us some insight on what the overall economy might be headed for. So let's get a market posture going. Let's analyze the chart, and let's just try to determine, with a mixed bag of data, we've got some reasons to believe that we could be headed higher, we might be headed lower, but looking at the chart, that paints a big picture. So number one, first of all, we got to look at what the trend is doing. And if we look at the 50-day simple moving average, you can see that it's been going up. However, it's slowing down and starting to flatline. We could call this a sideways trend. In a sideways trend, you look for where's support and where's resistance. Are we on our way back down to support down here? Very much could be. In fact, Friday's price action, if you look at the volume down here, look at all this volume. Huge spike, big down day, not looking good for the market. We could get some continuation. However, since we have been in an overall uptrend, a lot of traders are saying that was a gift. Big down day, some exhaustion move, and we could get a quick snap back up in price. Look at the last couple of big down days, and look what the market did right after. Kind of had a move up right where my cursor is. Back here, big down day. That was near the top of our run, but we were way overextended above the 50-day moving average. You know, we had a couple of up days, but then it did continue on down for a little while. So let's take a look at the highs and lows. Let's just draw a trend line here, and you can see we're getting some lower highs. And if that holds, we could potentially be in some kind of a triangle formation, which is a consolidation phase. We'll see what it does, whether it decides to break to the downside or the upside. So the prior trend was up. We have to side with the prior trend, but the market is showing some signs of consolidation. So in summary, we've been getting a lot of mixed signals based on the data in the market. We've been having some up days on negative data, some down days on positive data. We've got the big one coming up here next Wednesday, the 20th. Seasonality says that the market tends to have some difficulties in September. September isn't the friendliest month for the market. And when we're looking at the chart, it looked like we're in kind of a consolidation. My posture is, after such a big down day on Friday on high volume, based on some recent moves, I expect a little bit of a short-term snap back up in price, maybe Monday and Tuesday. But then depending on the data on Wednesday, if there's any major surprises, we could get some more volatile moves. Ultimately, though, I think it's okay to be a little bit more cautious up here. I'm not expecting a ton one way or another. It's one of those situations where sometimes you're trading, you see a really strong signal, you go ahead and you buy calls or puts based on that signal. I'm not really seeing a lot of strong signals right now. So any kind of neutral type trades to slightly directional, I think makes sense. Is it time to use a whole lot of extra caution? I don't necessarily know about that, but hey, we've always got our stop losses in place. We always position size and do proper money management. So if things really don't work out so well, it's not going to hurt our accounts that much. Number 1 rule is don't lose money. Number 2 rule is refer to number 1. That's the market update for this week with Scott Cook. Thanks for being here and good luck.